It's August 1, 2012, 9:30 in the morning, on a trading floor in Jersey City, New Jersey. A company called Knight Capital is about to lose more money in 45 minutes than most firms make across 5 entire years of business. Not a market crash. Not investor panic. Not a scandal splashed across the front page. Just a single forgotten piece of code, still switched on, waiting quietly inside one server that nobody in the entire company remembered even existed anymore. By 10:15 that same morning, 17 years of careful, patient work would be completely gone, wiped away before most of the country had even poured its second cup of coffee. This is the story of one of Wall Street's biggest and most respected trading firms, and the 45 minutes that quietly, almost invisibly, ended it for good. Engineers still study this exact collapse today, not as a scandal but as a permanent warning. Knight Capital was founded in 1995, in an era when electronic trading was still new to Wall Street, a strange and largely unproven idea to many older, more traditional brokers of that time. Most ordinary people outside the industry had never once heard the name, but inside the market itself, Knight was already quietly becoming a giant in the making. It wasn't a bank, and it certainly wasn't a household brand anyone recognized on the street. It was something called a market maker, the invisible machinery that matches millions of stock trades every single day, instantly, silently, without almost anyone outside finance ever noticing it happening at all. When an ordinary investor taps buy on a brokerage app today, someone on the other side has to fill that order immediately at a fair price in a fraction of a second. That someone, more often than not throughout the 90s and 2000s, was Knight. The company grew quietly through the late 90s, building careful relationships with brokerages across the entire country, refining its technology year after year, hiring engineers who understood both finance and computer code equally well. It survived the dot-com crash of 2000, a brutal moment that wiped out hundreds of smaller, less disciplined trading firms almost overnight. Where competitors collapsed under that sudden pressure, Knight adapted quickly, tightened its internal systems, and kept expanding steadily year after year, deal after deal. By the mid-2000s, it had become one of the most trusted names in high-frequency trading, a business built entirely on speed, precision, and quiet trust in machines that almost nobody outside the industry ever stopped to think about. By 2012, Knight Capital was no longer a scrappy upstart fighting for relevance on Wall Street. It was handling almost 17% of all trading volume on the New York Stock Exchange, and roughly 16% of trading volume on the NASDAQ. Think about that number for a moment, really sit with it. One single company quietly routing and matching a huge slice of every stock trade happening across American markets, every single trading day, without most ordinary investors ever knowing its name existed at all. Knight employed more than 1,400 people across multiple offices, ran server farms humming around the clock inside climate-controlled rooms, and had weathered the entire 2008 financial crisis without a single major client walking away in panic. Its CEO, Thomas Joyce, had spent years carefully building the firm's reputation as steady, dependable, almost boring in the best possible sense of that word inside an industry known for volatility. Wall Street trusted Knight precisely because nothing dramatic ever seemed to happen there, year after year, quarter after quarter, filing after filing. Competing firms studied its risk management practices closely, hoping to replicate its consistency. Regulators routinely pointed to Knight as a textbook example of market infrastructure done properly, done safely, done right. There was simply no reason in the summer of 2012 for anyone inside or outside the company to imagine Knight Capital was anything but stable, permanent, one of the quiet, dependable pillars holding up the market's daily rhythm. Financial journalists rarely wrote about Knight at all, and inside the industry, that silence itself was considered the highest possible compliment a trading firm could ever earn. Employees spoke of a steady, engineering-first culture, one that prized careful process over reckless, flashy risk-taking that had sunk so many of its flashier competitors. Thomas Joyce himself was frequently invited to speak at industry panels about resilience, about discipline, about building systems built to last for decades, not quarters. Then, in the summer of 2012, the New York Stock Exchange announced a new initiative called the Retail Liquidity Program, designed to give everyday individual investors slightly better prices on their ordinary trades. To participate in this new program, firms like Knight needed updated software capable of handling this unfamiliar new type of order flowing through their systems. Knight's engineers began writing that code under a tight rollout deadline, the way engineers at every company everywhere so often quietly do under pressure. Buried deep inside Knight's much older systems was a piece of software called PowerPeg, an internal testing tool built years earlier, never properly retired, quietly sitting dormant and forgotten on the company's live production servers all this time. The new code reused an old technical flag, one that used to activate PowerPeg automatically during testing, on the quiet assumption it would simply be overwritten everywhere it still existed across the entire system. On deployment day, that quiet assumption turned out to be dangerously, catastrophically wrong. Knight had 8 separate servers responsible for routing live customer orders directly into the market. 7 of those 8 servers received the update correctly, exactly as engineers had planned and tested. 1 single server did not. Nobody flagged the discrepancy during testing. No automated alert fired to warn anyone. No senior engineer manually double-checked that 8th machine sat there, quietly misconfigured, before markets opened the very next trading morning across the country. It was, by every account given afterward, an almost invisible mistake, the small forgettable kind of oversight that happens quietly inside nearly every company, every single week, and almost always harmlessly, means absolutely nothing at all. That night, engineers went home. Servers hummed quietly through the dark. Nobody in the building had any reason to suspect that one of those 8 machines was about to wake something dangerous up the moment trading began the next morning. It was, in hindsight, the calm, unremarkable evening before the storm. At 9:30 a.m. on August 1st, the market opened right on schedule, and Knight Systems began processing the new retail liquidity order type across all 8 of its servers simultaneously, exactly as planned the night before. On 7 of those servers, everything worked exactly as designed, silent and invisible, the way good financial infrastructure is always supposed to quietly behave in the background. On the 8th server, the long-dormant PowerPeg code suddenly woke up from years of silence, and it began buying and selling stock automatically, at enormous and unrelenting speed, with no real trading strategy behind it whatsoever, simply looping endlessly, entirely on its own accord. Within minutes, traders inside Knight's own office began noticing something was deeply, unmistakably wrong on their screens. Prices in over 150 different publicly traded stocks were swinging wildly and unpredictably, not from breaking news, not from genuine investor demand, but from Knight's own malfunctioning internal systems flooding the open market with runaway, erroneous orders nobody had authorized. Engineers scrambled frantically across the office to find the source of the problem, pulling server logs, checking dashboards, asking one urgent question nobody could yet answer with any real confidence at all. Why is this happening right now, in real time, and how quickly can we possibly stop it before it gets worse? Phones started ringing constantly. Other trading firms, confused by the sudden chaos rippling through the market, began calling Knight directly, asking what on earth was going on with these strange, erratic trades. Some Knight employees, believing this was an external market data feed error rather than their own internal malfunctioning system, tried manually adjusting stock positions by hand, which only deepened the growing chaos even further across the floor. Minutes kept passing, one after another, each one more expensive than the last. Stock tickers kept scrolling faster and faster across every screen in the building. Losses kept silently climbing in the background, invisible to the wider public still going calmly about their ordinary Wednesday morning, entirely visible to one small, increasingly panicked room in Jersey City. Senior engineers were pulled out of unrelated meetings. Risk officers stood over shoulders, watching numbers climb on shared screens. By the time someone finally located the single rogue server buried among the other 7 and threw the emergency kill switch, the clock on the wall read 10:15 precisely. 45 minutes had passed since that morning's opening bell first rang across the exchange floor. In that narrow window of time, Knight Systems had executed billions of dollars worth of completely unintended trades, accidentally acquiring massive, unwanted stock positions across more than 100 different publicly traded companies. By the end of that single trading day, the final number was confirmed by Knight's own internal accountants, and it was staggering. $440 million gone, entirely erased, more than the company's combined net income across the previous 2 entire years put together. The very next morning, Knight's own publicly traded stock price collapsed by over 30% in a single trading session, and clients, some of the largest brokerages in the entire country, began quietly pulling their business away within hours, genuinely terrified the firm itself might not even survive through the coming week. Knight's capital base, the financial reserve every registered broker-dealer is legally required to maintain at all times, had been almost entirely wiped out in a single chaotic trading session. Without emergency funding arriving within days, the company was realistically facing forced closure by federal regulators. In a scramble Wall Street would talk about for years afterward, a group of outside investors hastily assembled a $400 million emergency rescue package overnight, in exchange for a controlling ownership stake in whatever remained of the battered firm. Knight technically survived that terrifying week, but the company that emerged from the rescue bore very little real resemblance to the proud one that had opened its doors that August morning. Within a single year, it merged quietly with a rival firm named GetGo, and the Knight Capital name, 17 years old and once deeply respected across the industry, disappeared from Wall Street directories for good, absorbed into something else entirely. What makes this particular collapse so different from most other Wall Street disaster stories is precisely what it wasn't. Nobody lied to investors here. Nobody stole a single cent from a client account. There was no criminal mastermind quietly pulling strings behind some elaborate, calculated scheme. It was simply a deployment mistake, one unresolved technical flag, one forgotten piece of old code, sitting quietly on one overlooked server that nobody had thought to carefully check beforehand. Regulators later concluded, in their official findings, that Knight's own testing environment simply hadn't been rigorous enough to catch an error exactly like this one before it ever reached a live, real trading market full of real money. The Securities and Exchange Commission eventually fined Knight several $1 million for failing to maintain adequate internal safeguards, a relatively small penalty compared to the far larger loss the company itself had already suffered on that single chaotic morning in August. Trading desks across Wall Street quietly rewrote their own deployment checklists that year, terrified of becoming the next cautionary tale. 17 years to carefully build an empire. 45 minutes to erase every bit of it completely, without warning. Knight Capital's story remains a quiet warning to every engineer, every trader, every company still running old code they've long since stopped thinking about entirely. If this story genuinely fascinated you, there are dozens more forgotten Wall Street and tech collapses waiting to be uncovered on this very channel. Subscribe now so you genuinely never miss the next hidden collapse we carefully uncover on this channel.